Hello and welcome back. In this video, we are going to walk through some dividend problems, whether it's cash dividend problem, stock dividend problem. I have about 5 dividend problems that I want to do with you. So grab your book, come with me. The first one we're going to do is brief exercise 15.10. For this one, we have Wolford Inc. declaring a cash dividend of $1 per share on its 2 million outstanding shares. The dividend was declared on August 1st, payable on September 9th to all stockholders of record on August 15th. And we need to prepare all journal entries necessary on those 3 dates. So when it comes to dividends, remember we have 3 important dates: the date of declaration, the date of record, and the date of payment or distribution. So for this one, we are first going to deal with the date of declaration, which was August 1st. Now, I just read the date and I forgot the date already. August 1st, on the date of declaration, a liability will be created, or it is created. The corporation now owes those stockholders this dividend because they said they were going to pay it. All dividends are paid from the retained earnings account. So that means we're reducing retained earnings. So we're going to debit retained earnings. And the amount is going to be the $1 times the 2 million shares outstanding. If we have enough zeros there. The credit is going to go to my liability account, dividend payable. Now in accounting 2, we called it common dividend payable, but if you just want to call it dividend payable, that works as well. Dividend payable is just fine. Record the declaration of dividends. That is not how you spell declaration. Declaration of dividends. Now, the next important date was August 15th, which is my favorite date because I don't have to do anything. This is the date of record, and there is no entry required. It just gives the broker enough time to determine who owns the stock as of that day. Now, the last important date is the date of payment when we get rid of the liability, and this was 9/9. So on 9/9, this becomes an accounting 1 entry where we're paying off a liability. So we debit dividend payable for that 2 million, and we credit cash. So record payment of dividends. So remember those 3 important dates. We're going to see those dates over and over again, whether it's a cash dividend, a property dividend, a stock dividend. It's going to look very similar. So let's do another one. Let's look at brief exercise 15.11. Let me copy and paste. My formatting is there, and I like my formatting. All right. Brief exercise 15.11. This time we have Coal Inc. owning shares of Marlin Corporation stock. That's interesting. At December 31st, 2020, the securities were carried on in Coal's accounting records at their cost of $875,000, which equals their fair value. On September 21st, 2021, when the fair value of the securities was 1.2 million, Coal declared a property dividend, whereby the Marlin securities are to be distributed on October 23rd, 2021 to stockholders of record on October 8th, 2021. Prepare all journal entries necessary on those 3 dates. So again, this is still dividends, but this is a property dividend. So instead of giving cash, we're giving out securities or equity investments. When we give out equity investments, the first thing we need to do is update the equity investment to reflect the fair value as of the date of declaration. So we have to get the right fair value on the books. So we don't have a crystal ball. So in the future, we have no clue what the fair value is going to be on the date of payment. So we record that liability as of the fair value on the date of declaration. So my first date here was 9/21. Now, if you remember, the original value of these investments was $875, but now it's worth $1.2 million. So the difference between that $875 and that $1.2 million is the amount that I need to use to increase the value of my equity investment. So we're going to debit the equity investment, and that's just an asset. So we're making it higher. We're making it more because it should be 1.25 million. So we debit equity investments, and we can call it investments, for 325, and we credit our unrealized holding gain or loss dash income account. Now remember, a realized gain or loss happens when we actually sell it. But this time we're not selling it, we're just updating the fair value of it. So we have to record that unrealized holding gain or loss. Now it's dash income, so it's still going to show up in the calculation of net income on my income statement, and that's because we're getting rid of this investment this period. So then that makes it a short-term investment. To update fair value of equity investments. Now, that is the first entry that we have to do on the date of declaration. The second entry is for the actual declaration of the dividend. All dividends are paid from the retained earnings account, even if it's an equity investment that we're giving to our shareholders. So we debit retained earnings for 1.2 million. And the reason why I'm using the 1.2 million is because that is now the value of my equity investments. And we are going to credit dividends payable. Property dividend. Now, I don't know if there was a date of record. Let's see. Yes, on October 8th, but it's really not all that important because on the date of record, I don't have to do anything. So no entry. And I've actually seen this situation play out. In one of the investments that I had, all of a sudden I looked at my list one day, woke up the next day, I looked at the list, and there is a new type of stock that I know I didn't buy. And I'm thinking, oh gosh, somebody hacked my account. What in the world is going on? And then I finally checked my email and I saw that as a dividend, we received additional shares of a stock that the corporation that I owned. So then I became the owner of a new type of corporation simply because I was given a property dividend. So on the date of distribution, and we don't necessarily, we can call this a date of payment, but because we're not giving out cash, we kind of like to use the term date of distribution. It doesn't matter. The entry is still generally going to be the same in terms of us debiting the liability and crediting some type of asset. So I don't remember my date. October 23rd. So on October 23rd, we are going to give the equity investments to our stockholders. So we take dividends payable or dividend payable, whichever one floats your boat, off the books. And we're also going to take the equity investment off the books. Distribution of property dividend. Okay. And that was brief exercise 15.11. Let's do another one because you can never do too many problems when it comes to dividends because there's so many different types of dividends. So let's do another one. Let's do brief exercise 15.12, I think. Yes, 15.12. So we have Graves Mining Company declared on April 20th a dividend of $500,000 payable on June 1st. Of this amount, $125,000 is a return of capital, and we need to prepare the April 20th and June 1st entries for Graves. So this one is actually a liquidating dividend, where When we look at what we're giving out, a portion of it represents earnings that we're sharing with our owners, but the other portion represents a return of their original investment. And our journal entry has to look that way. So let me copy, getting ahead of myself here. All right, now my first date that they gave me, I forgot it. I just read the date, April 20th. So on 4/20, I have to record that this dividend is declared. When dividends are a distribution of earnings and it's not a liquidating dividend, we debit retained earnings. But the portion of the dividend that represents a return of capital comes from the PIK in excess of par account. So we end up debiting PIK in excess of par because we're giving those original investors a portion of their investment back. And the credit still goes to dividend payable. The return of capital is the debit amount to PIK in excess of par. Retained earnings is just the rest of it. So the total dividend was $500,000. So let me make sure I know how to subtract today. Okay. So the credit of $500,000 goes to dividend payable or dividends payable, whichever one floats your boat. And liquidating dividend. Now, on the date of payment, which I believe happens on June 1st, on the date of payment, that entry looks exactly the same as what we saw with the regular old cash dividend. We take the dividend payable off the books and we credit cash for the full $500,000. So the big change was the return of capital piece and how we treat that. If it's a return of capital, it can't come from retained earnings. It has to come from PIK in excess of par. So this was brief exercise 15.12. So I think I said I was going to do 5 of them with you. So that's 3 down, 3, and 2 more to go. So let's do the next 2 in sequential order. Brief exercise 15.13 is the next one we'll look at. For this one, we have Green Day Corporation has outstanding 400,000 shares of $10 par value common stock. The corporation declares a 5% dividend when the fair value of the stock is $65 per share. Oh, this is a stock dividend. This is a good one. Prepare the journal entries for Green Day Corporation for both the date of declaration and the date of distribution. So remember, with stock dividends, instead of giving out cash, we're giving out additional shares of stock. So in doing that, we have to determine, oh, I went too far. We have to determine the value of these shares. In other words, determine how much we're going to debit retained earnings for. All small stock dividends are valued at market value. All large stock dividends are valued at par value. Any stock dividend that's lower than 25%, generally between 20 and 25%, but we kind of use 25% as the line of demarcation. Those are small stock dividends. We use market value to debit retained earnings. Above 25%, large stock dividends, we use par value to debit retained earnings. Now for this one, this was a 5% stock dividend. So this means it's a small stock dividend. We're using the market value. The first thing we need to do is to determine how many additional shares of stock we will be issuing as a result of this stock dividend. So if there are currently 400,000 shares outstanding and the stock dividend percentage is 5%, that means we're going to be distributing an additional, look if I have too many zeros here. So that's going to give me 20,000 shares, additional shares. Now, the value of those 20,000 additional shares is going to be based on that market value of $65 per share. So when we do our entry here, we're going to debit retained earnings. I've got to put my date. Did they give me dates? No, they did not. I'll make up my own date. So we're going to debit retained earnings for the 20,000 shares times the market value of $65 per share. It should be the 1.3 million. 20,000 shares times 65. Now, because we are in this dividend distributing additional shares of stock, but we're not doing it all in the same day, I know that I need to put common stock on the books, but because we're not doing it all on the same day, I can't just go ahead and credit common stock because I don't have my shares ready to go yet. So we have to use our placeholder account. It's an equity account. So we're not using a liability account. We're using an equity account called common dividend distributable. And this common stock, you can call it common stock dividend distributable or common dividend distributable. Let me be consistent and call it common stock dividend distributable. That should be valued at par value. So I'm going to take my 20,000 shares and I'm going to multiply that times the par value of 10. Now, of course, my entry doesn't balance, and that's because this is a small stock dividend. So the market value gets debited to retained earnings, but the par value has been credited to common stock dividend distributable. So this is where I use my good old-fashioned pick in excess of par, comma, common stock account for the difference between those two. And we add in our description. Now, on the date of distribution, sometimes it's declared and distributed all in the same day. And if it happens that way, then you would just credit common stock instead of crediting common stock dividend distributable. On the date of, in this case, that didn't happen. So on the date of distribution, what we have to do is take common stock dividend distributable. I can't type and talk at the same time. Sorry about that. We have to take common stock dividend distributable off the books, and we put common stock on. I don't have to worry about my pick in excess of par. I've already recorded that. We don't mind recording that ahead of time. But with common stock, we usually have to wait until the shares are in the hands or the possession of those stockholders. All right, small stock dividend. Now let's look at a large stock dividend problem, and that would be brief exercise 15.4, 15.14. For brief exercise 15.14, we need to use the same information from brief exercise 15.13, but assume Green Day Corporation declared a 100% stock dividend rather than a 5% stock dividend. So we're looking at a large stock dividend this time, 100%. So we need to prepare the entries for both the date of declaration and the date of distribution. So all the same facts, only we've changed that dividend percentage, which of course will change my journal entry. Let me label this before I mess this up. And this one is 15.14. I want to make this bigger, but I need to see what's going on. And let's see what we're going to change in our entry. As a matter of fact, let's just do it from scratch. It'll be better if we do it from scratch. Now, this is a 100% stock dividend. So I'm going to take my 400,000 shares that were outstanding, And I'm going to multiply them times 100%, which I know is just 400,000 shares. So we are issuing an additional 400,000 shares. Large stock dividends are valued at par value. So when we do our entry here on the date of declaration, we're going to debit retained earnings for that par value. So it's going to be the 400,000 additional shares. I have too many zeros. Times the $10. I better get 4 million. Okay. Shares times $10. Now, we're going to credit common stock dividend distributable using the par value because this is a large stock dividend. So it's essentially the same thing. It's still 400,000 shares at $10. My journal entry balances. I don't need any PIK in excess of par because we're debiting or capitalizing retained earnings at the par value. So it really does make my entry a whole lot easier. That's all I have to do. Large stock dividend. Now, on the date of distribution, it's the same as what we saw before. I take common stock dividend distributable off the books. And we put common stock on. So a large stock dividend actually requires less work. All right. Now that takes care of all of the problems that relate to dividends, whether it's cash dividend, property dividend, stock dividend. I so appreciate your time and attention. Hopefully this is enough to get you started on this portion of your homework assignment for chapter 15. I hope you have a wonderful day.